The Treasury Department will auction $93 billion of government debt on Thursday. This is not unusual. Treasury auctions occur weekly. They are the mechanism through which the United States finances its operations, rolling over maturing debt, funding new deficits, keeping the machinery of government functioning. What is unusual is the context. Foreign buyers have reduced their participation in Treasury auctions for 7 consecutive months. The bid-to-cover ratio, the measure of demand relative to supply, has fallen to levels not seen since 2019. Primary dealers, the banks required to absorb unsold treasuries, are already holding record inventories they cannot easily offload. $93 billion must find buyers by Thursday afternoon, and the buyers are not there. This is the 72-hour window that the Federal Reserve faces, not a window of opportunity, a window of necessity. If Thursday's auction fails, if demand is insufficient, if yields spike to attract reluctant buyers, if the market signals that U.S. government debt is no longer the safe asset it was assumed to be, the consequences cascade immediately. The Fed will have a choice: announce quantitative easing to absorb the debt the market will not buy, or allow the Treasury market to reprice in ways that threaten the entire financial system. This is not speculation about policy preferences. This is arithmetic about funding requirements. The question is not whether QE returns. The trajectory of debt and the absence of buyers have already answered that question. The question is whether the announcement comes before the crisis or after. And silver, the monetary metal that reflects confidence in real time, is already pricing the answer. There is a belief, widely held, that quantitative easing is a policy choice. The belief suggests that the Federal Reserve considers economic conditions, weighs costs and benefits, and decides whether QE is appropriate. If inflation is high, QE is inappropriate. If growth is strong, QE is unnecessary. The Fed exercises discretion based on its dual mandate of price stability and maximum employment. This belief was accurate once. It is no longer. Quantitative easing has transitioned from policy tool to structural necessity. The United States government spends approximately $6.5 trillion annually. It collects approximately $4.5 trillion in revenue. The difference, $2 trillion, must be borrowed. But the borrowing does not stop at the annual deficit. Existing debt continuously matures and must be refinanced. In 2025, over $8 trillion of Treasury securities will mature and require rollover. Total borrowing requirement, approximately $10 trillion. This borrowing must find buyers. Someone must purchase $10 trillion of Treasury securities this year alone. Historically, the buyers were diverse. Foreign central banks seeking reserve assets, domestic pension funds seeking safe returns, international investors seeking dollar exposure. But the buyer base is contracting. China has reduced its Treasury holdings for 37 consecutive months. Japan, facing its own monetary pressures, has stopped accumulating. European institutions, burned by the weaponization of dollar reserves and the Russia sanctions, have grown cautious. Domestic buyers remain, but domestic buyers alone cannot absorb $10 trillion of issuance while also funding mortgages, corporate bonds, municipal debt, and the other borrowing needs of a debt-dependent economy. The arithmetic produces a conclusion that policy preferences cannot override. If private buyers cannot absorb Treasury issuance, a public buyer must. The only public buyer with unlimited capacity is the Federal Reserve. QE is not a choice. QE is the inevitable outcome of a fiscal trajectory that has no other resolution. The history of quantitative easing illuminates the pattern now reaching its logical conclusion. In November 2008, the Federal Reserve announced QE1, the first large-scale asset purchase program in its history. The context was crisis. Lehman Brothers had failed. Credit markets were frozen. The financial system was experiencing cardiac arrest. QE1 was presented as an emergency measure. The Fed purchased over $1.5 trillion of mortgage-backed securities and Treasury securities. The immediate crisis passed. The program was supposed to be temporary. In November 2010, the Fed announced QE2. The economy had stabilized but was not growing sufficiently. Unemployment remained elevated. The Fed purchased an additional $600 billion of Treasuries. QE2 was also presented as temporary, a bridge to recovery. In September 2012, the Fed announced QE3. This time, the program was open-ended, no specified limit, no defined endpoint. The Fed would purchase $85 billion per month until conditions improved. QE3 continued until October 2014. Total Fed balance sheet expansion from $900 billion before the crisis to $4.5 trillion. The pattern was established. Crisis triggers QE, QE becomes normalized, normalization proves impossible, the next crisis triggers more QE. In March 2020, the pattern repeated at unprecedented scale. The pandemic triggered market panic. The Fed announced unlimited QE, no cap on purchases. Within 2 years, the balance sheet expanded from $4 trillion to $9 trillion. Each iteration was larger than the last. Each was presented as temporary. Each became structural. The Fed attempted to reverse course in 2022 and 2023. Interest rates were raised. Quantitative tightening, the reduction of the balance sheet, was initiated, but the tightening created its own crises. Regional banks failed when their Treasury portfolios lost value. The Treasury market experienced liquidity stress that required Fed intervention even while tightening was supposedly underway. The pattern is clear. The system has become dependent on QE. Withdrawal of QE creates instability. Instability triggers the return of QE. The 72-hour window now facing the Fed is another iteration of this pattern. Silver's behavior during previous QE episodes provides context for the current moment. During QE1, silver rose from $9 to approximately $18, a 100% increase. During QE2, silver rose from $18 to nearly $50, a 170% increase. During QE3, silver initially declined as the market anticipated tapering, then stabilized in the $15 to $20 range as QE became the new normal. During the 2020 unlimited QE, silver rose from $12 to $30, a 150% increase, in less than 6 months. The pattern is consistent. When the Fed expands its balance sheet, silver rises, not because silver traders are making predictions, because silver reflects the dilution of paper currency in real time. QE is currency creation. The Fed creates dollars to purchase assets. Those dollars enter the financial system. The supply of dollars expands while the supply of silver remains constrained by geology. Silver's price is a ratio, dollars per ounce. When the numerator expands and the denominator remains stable, the ratio rises. This is not complicated. This is arithmetic. The current silver price already reflects partial anticipation of QE resumption. The market has been watching the same Treasury auction data, the same foreign buyer withdrawal, the same fiscal arithmetic. But partial anticipation is not full pricing. If the Fed announces QE before Thursday's auction, preemptively, to ensure the auction succeeds, silver will respond to the confirmation of what was suspected. If the Fed delays, if Thursday's auction fails, or nearly fails, if the announcement comes in crisis mode rather than preemptive mode, the response will be more violent. The difference is not whether QE occurs. The difference is whether QE is announced from a position of control or a position of desperation. Markets respond differently to controlled policy versus emergency intervention. Emergency intervention signals loss of control. Loss of control triggers repositioning. Repositioning in a thin market, and silver is a thin market, produces outsized moves. The mechanics of Thursday's auction deserve specific attention. The Treasury will offer approximately $40 billion of 10-year notes and $53 billion of 30-year bonds across multiple auctions. These securities must be sold to fund ongoing government operations. There is no option to postpone. There is no option to reduce the offering size without reducing government spending, which requires congressional action that cannot occur in 72 hours. The auction process works as follows. Primary dealers submit bids specifying the yield they require to purchase the securities. The Treasury accepts bids from lowest yield to highest until the entire offering is sold. If demand is robust, the auction clears at a low yield. The government borrows cheaply. Markets interpret this as confidence in U.S. credit. If demand is weak, the auction clears at a higher yield or requires primary dealers to absorb securities at yields they did not want. Building inventory they must eventually sell at a loss. Weak auctions do not occur in isolation. A weak auction signals reduced confidence. Reduced confidence affects the next auction. A negative feedback loop can develop where each auction is weaker than the last. The Treasury market is $250 trillion in size, the largest securities market in the world. It is the benchmark against which all other borrowing is priced. Mortgage rates, corporate bond yields, municipal borrowing costs, all reference Treasury yields. If Treasury auctions begin to fail, if yields spike to attract buyers who are no longer naturally present, the entire structure of American borrowing costs reprices. This is the systemic risk that the Fed must weigh. The Fed can allow the auction to proceed without support. If it succeeds, the Fed preserves optionality. If it fails, the Fed faces emergency intervention under worse conditions. Or the Fed can announce QE preemptively, backstopping the auction, ensuring success, but confirming that the Treasury market can no longer function without Fed support. Neither option is good. The Fed is choosing between bad and worse, and the choice must be made within 72 hours. Foreign participation in Treasury markets has declined for reasons that cannot be quickly reversed. China's Treasury holdings have fallen from over $1.2 trillion to below $800 billion. This decline accelerated after the freezing of Russian reserves demonstrated that dollar holdings carry political risk. China has not announced a policy of Treasury divestment. The selling has been steady, undramatic, and persistent. Each month, holdings decline slightly. The cumulative effect over 3 years is a reduction of over $400 billion. Japan, the other major foreign holder, faces its own constraints. The Bank of Japan's policy shift has created incentives for Japanese institutions to repatriate capital. Why hold U.S. treasuries with currency risk when Japanese bonds now offer competitive yields without currency risk? European institutions have grown cautious. The Russia sanctions established a precedent. Reserves held in the dollar system can be frozen by political decision. European banks and central banks have not abandoned treasuries, but they have stopped increasing allocations. The petrodollar system, which once recycled oil revenues into treasury purchases, has weakened. Saudi Arabia now settles oil trades in multiple currencies. The automatic demand for treasuries from oil exporters no longer functions as it did. Each of these developments has its own logic, its own timeline, its own contributing factors, but the aggregate effect is simple. The foreign bid for treasuries has structurally declined. This decline cannot be reversed by Fed policy. The Fed cannot force China to buy treasuries. The Fed cannot force Japan to maintain foreign allocations. The Fed cannot force European institutions to ignore the precedent of reserve freezing. The only variable the Fed controls is its own balance sheet. If foreign buyers will not absorb treasury issuance, and if domestic buyers are insufficient, the Fed must become the buyer. This is not a policy preference. This is a mathematical identity. There are beliefs about QE that circulate widely and deserve examination. The first belief is that QE is inflationary and therefore the Fed will resist it. This belief contains truth but misses context. QE is inflationary in the sense that it expands the money supply. More dollars chasing the same goods and services produces higher prices, all else equal. But the Fed faces a choice between inflationary QE and deflationary Treasury market collapse. If Treasury yields spike because the Fed refuses to intervene, the entire economy reprices. Mortgage rates surge. Corporate borrowing costs explode. Asset values crash. The deflationary impulse from wealth destruction and credit contraction could exceed the inflationary impulse from QE. The Fed will choose inflation over deflation. It has made this choice repeatedly. It will make it again. The second belief is that QE can be sterilized or limited to prevent inflationary consequences. This belief held some validity in earlier QE episodes when the expansion was temporary and could theoretically be reversed. But the current situation involves a structural gap between Treasury issuance and private demand. The gap is not temporary. It is a function of fiscal policy that shows no sign of changing. Sterilized or limited QE does not solve a structural gap. It merely delays the recognition of the gap. The third belief is that high interest rates will attract foreign buyers back to treasuries. Higher yields do attract some buyers, but higher yields also increase the deficit. More interest expense means more borrowing. More borrowing means more issuance. More issuance requires more buyers. At current debt levels, raising rates to attract buyers is self-defeating. Each percentage point increase in average borrowing costs adds hundreds of billions to annual interest expense. The Fed cannot solve the demand problem by raising rates. It can only create a larger supply problem. The fourth belief is that fiscal responsibility will eventually reduce borrowing needs and solve the problem. This belief requires a political consensus that does not exist. Neither major political party has proposed fiscal consolidation sufficient to stabilize the debt trajectory. Mandatory spending, Social Security, Medicare, interest expense, grows automatically without congressional action. Waiting for fiscal responsibility to solve the Treasury demand problem is not a strategy. It is hope. And hope, as has been observed, is not a strategy. The 72-hour window represents a phased transition in monetary policy. Before the window closes, there remains ambiguity. Perhaps the auction will succeed. Perhaps foreign demand will materialize. Perhaps the Fed can maintain the fiction that QE is a choice rather than a necessity. After the window closes, after Thursday's auction reveals the true state of demand, the ambiguity ends. Either the auction succeeds, in which case the Fed gains time before the next auction creates the same stress, or the auction fails, in which case the Fed must act immediately from a position of weakness, with markets already pricing the loss of control. Or the Fed announces QE preemptively before the auction, ensuring success but confirming dependency. Each path leads to the same destination, QE as permanent feature rather than temporary tool. The difference is the path taken. The difference is whether the transition occurs through controlled acknowledgement or chaotic revelation. Markets price chaos differently than they price control. Silver prices chaos differently than it prices control. The silver market is small relative to treasury markets, currency markets, and equity markets. Total above-ground silver is approximately 2 billion ounces. At current prices, the entire global silver supply is worth roughly $100 billion. $100 billion is a rounding error in treasury markets. It is less than one day's trading volume in currency markets. It is a fraction of a single large technology company's market capitalization. This smallness is precisely why silver responds violently to monetary shifts. When capital seeks to exit paper assets, when confidence in currencies erodes, when treasury markets show stress, when the permanence of QE becomes undeniable, silver is one of the few destinations that offers what paper cannot. No counterparty risk, no default risk, no debasement by policy decision, but the silver market cannot absorb large flows without large price movements. If even a small percentage of the capital currently allocated to treasuries, to money market funds, to bank deposits seeks the safety of physical silver, the price must rise to ration the limited supply. This is not speculation about investor behavior. This is observation about market structure. The conditions for such flows are now present. The trigger, the confirmation that QE is not temporary but permanent, may arrive within 72 hours. Gold will move with silver, though likely with less violence. Gold's market is larger. Gold's central bank holdings provide a buffer of supply that can theoretically be mobilized. Gold's price movements, while significant, are dampened by market depth. But gold and silver moved together during monetary regime changes. They moved together in the 1970s. They moved together in 2008, 2011. They moved together in 2020. The ratio between gold and silver, currently around 50-1, will compress if silver moves faster. This compression is typical during monetary stress. The silver move will be more dramatic in percentage terms. The gold move will be larger in absolute dollar terms. Both moves will reflect the same underlying reality, that the monetary system is transitioning from a posture of normalization to a posture of permanent accommodation. There are those who will dismiss this analysis as alarmist. They will point to previous predictions of Treasury market failure that did not materialize. They will note that the Fed has always found ways to manage crises. They will argue that the dollar's reserve status provides unlimited demand for treasuries. These objections contain historical truth and present blindness. Yes, the Fed has managed previous crises, but each management required larger interventions than the last. The trajectory is not toward stability, but toward dependence. Yes, the dollar's reserve status provides demand, but that demand is contracting, not expanding. The trend is visible in the data. Yes, previous predictions of failure did not materialize on their predicted timelines, but the conditions that generated those predictions have not resolved. They have intensified. The question is not whether the analysis is alarmist. The question is whether the analysis is accurate. And accuracy is tested not by the comfort it provides, but by the data it explains. The data shows declining foreign participation in Treasury auctions. The data shows rising bid to cover stress. The data shows fiscal deficits that require more borrowing than private markets will voluntarily absorb. The analysis follows from the data. The conclusion follows from the analysis. Whether the conclusion is alarming is a separate question from whether it is correct. This is not a prediction of financial collapse. Systems adapt, policies adjust, crises are managed, postponed, transformed. The Fed will announce QE. Treasury auctions will be supported. The immediate stress will pass. But each support, each intervention, each confirmation that the system cannot function without central bank backstop, these accumulate. They accumulate in the balance sheet. They accumulate in the inflation rate. They accumulate in the confidence that citizens and foreigners place in the dollar. And they accumulate in the price of silver. Silver does not predict Fed policy. Silver reflects the consequences of Fed policy, the dilution, the debasement, the slow erosion of purchasing power that occurs when currency creation becomes the solution to every problem. The 72-hour window is not unique. It is one window among many that have opened and will open as the monetary system navigates a debt burden that cannot be repaid in real terms. What is notable about this window is its visibility. The auction is scheduled. The data is public. The arithmetic is simple. Anyone can see what is coming. The only question is what price is attached to the seeing. Gold does not rise. Confidence falls. Silver does not spike. Systems reveal. The Fed's 72-hour window is not about choosing between QE and no QE. The window is about choosing between preemptive acknowledgement and reactive crisis management. Both paths lead to the same place: permanent monetary accommodation of fiscal deficits that cannot be financed through private markets. The path chosen affects the speed and violence of market adjustment. Silver will adjust regardless of path. The metal has no preference. It simply reflects. And what it reflects, in the coming 72 hours and beyond, is the arithmetic of a system where promises exceed the willingness to fund them. The buyers are not there. Someone must buy. The Fed will buy. And silver will price the buying, as it has priced every expansion, every intervention, every admission that paper systems require paper solutions. For those watching the signal, rather than waiting for the announcement, the signal has been sending for months. The announcement is 72 hours away, or less.